Recording in progress kicks it off. Okay, welcome everyone to the August 2024 AMA. I love that every single month now there are just more and more people on these. The hype is real, and we are getting closer to magnum opus. A couple weeks ago, I recorded the first 30 videos. I am hoping to get over 100 videos at launch. I am feverishly working on this stuff. It is hard to explain just how much time all of this takes. To perfect these scripts, get the visuals, work on the website, work on insurance, web design, marketing, all this stuff. But it is going to be amazing, and the recording's actually pretty fun. It's just hours going into it. So I've got a lot of good questions already from the Patreon. Sean, can you please ask what you asked me before we started recording so then I can address it?
Yeah, sure. So my question was basically like, I've got a bunch of these kind of like retail concepts that have been touted as like common knowledge, just like in my brain. For example, like the first one that we mentioned earlier was like R multiple and the concept of R multiple kind of being everything. And then another one is like, you should take the setup as long as there's edge versus like focusing on P&L. Like, and there's other things that are there that I don't know what to believe and what not anymore, because some of the stuff that like I thought was like common law almost is like now I'm finding out is complete bullshit sometimes. So I just want to know, like, point me in the right direction so that you know.
Yep. And so for context, Sean had asked on the Patreon, how do you approach the concept of risk reward? The concept of R multiple is something that is everywhere in retail world, and especially in FX and futures space. And for people that don't know, because I really this term only exists, I think, really kind of in retail world. I'm familiar with it now, but I wasn't back then. And it's essentially that your reward should be some multiple of your risk. And so then I kind of cheekishly responded, R multiple, Sean asked my take on it. How do I approach it? My take was that R multiple is the dumbest effing thing on earth. And I challenged Sean to tell me why. And we had some good debate in the comments. And so that's what brought up like that there's a lot of concepts out there in retail world, and some of them are good, some are bad, some are total BS. And so here's what I would say to this, Sean, is like the best thing you can do, and I would just encourage everyone to do, is you want to like dissect these concepts yourself and see if you can poke holes on them. Like, what is true? What isn't? Why might it be true? Why might it not be true? And take them really one by one. So now take something like there's the common saying, you can never go broke taking profits. Like, okay, like what does that mean? Where is that true? Like, how do people apply it? What's so hard with a lot of these kind of aphorisms that get popular is like a lot of them are lacking context. Like, you can't go broke taking profits. What does that actually mean? And so here's the thing, right? Like, if what that means is every time you're in the money, you start taking some of the trade off, you actually can go broke that way. Why? Because when it doesn't work in your favor, you're going to take a loss. But if you cut off and lop off your reward every time it goes in your favor, that's going to be a problem for you because you're not capturing your full reward. So think about this. Imagine if in poker, every time you had a good hand and you started to reel people in, you took some of the chips out of the pot, right? That's the opposite of what you want. You want more chips in the pot if you have a really, really good hand. And so imagine if instead of catching $1, every single time the trade was working in your favor, you took off half your size at plus 10 cents. If you did that, like, you are super, super hurting yourself. So there are times where like it's not right to always take profits. Like, if me taking profits is I'm selling where I really should be holding or adding size, that definitely can impair your trading. So now the concept of R multiple was something that's super common on Twitter world. And I've seen especially the whole belief that you need a 3-to-1 R multiple. You should only be in trades that have 3 times the reward as the risk. And so why, in my words, is that the dumbest freaking thing on earth? It's the dumbest thing on earth because it shows a fundamental misunderstanding of expected value. Expected value drives every single decision in trading, right? That's part of the magnum opus trailer for a reason. Like truly every single, like trading in a nutshell is what is the expected value of all these different things out there? Then are you placing your bets accordingly? And so when someone focuses on R multiple, they're missing an essential part of the equation, which is the win rate and the loss rate. And so if you're only focusing on 3-to-1 reward to risk, you might miss out on trades that otherwise are super, super amazing, right? So if I were to ask you, Sean, like, okay, what if this trade is only 1-to-1 risk reward or reward to risk? Sorry, it's the same, however you want to flip it. Say it's 1-to-1 reward to risk, but you're going to win 99.9% of the time. Are you going to take that trade?
Yeah, of course, every time.
100%, right? Absolutely. You are going to take that every time. And not only that, but I would bet a shit ton. I would bet so much money on that because 99.9 with 1-to-1 reward to risk, when you calculate that expected value, that's super, super amazing. You essentially make $1 every time you bet $1, pretty much, with a rounding error. And so the people that focus on R multiple, they are failing to factor in the win rate and everything, which is so important because it's not R multiple that drives expected value in your trading. It's expected value which factors in the win rate. And so like in Forex world, and I know we had like a more good debate lower because you were saying if your strike rate is 50%, 1-to-1 essentially becomes the break even point, which is all totally right. But here's the thing is in trading, most win rates aren't as simple as 50%. In fact, there's probably no trade out there that's exactly 50%. And so to oversimplify that way is a huge fallacy. And so then you mention essentially lower, but like look, like the reason why 50% is especially interesting because if you take a random walk, kind of half the time you might go up, half the time you might go lower. But the issue is the people that are assuming 50% win rate and kind of this random walk model, there's no edge if it's a random walk, right? For all the times you might make multiples, you're going to also be losing multiples. Or like, let's say my reward is 1 and my stop is 1. Like if it's truly 50-50, you're not making money because every time you make $1, you're losing $1. So it's really about the confluence of like, not just what the risk reward is, but also that win rate. And so like any single person that does that, I think you're just like oversimplifying. And I will admit that most traders probably like have like in day trading world, there aren't many strategies that you're going to win 99% of the time and stuff like that. So like, I think people just had it as like a decent rule of thumb where it's like, oh, if my reward is 3-to-1 or something, then I only need to be right effectively, like a third of the time or whatever. And but it's just not a good way to think about it because you really need to factor in all of it. Does that kind of make sense?
Yeah, you actually said something that was like really interesting, I thought in there. That was you said that when you take like a strategy in a random walk, rarely is it like 50% all of the time. So if it's like quote unquote the same trade setup, right? But you're saying it's not 50% all the time. What do you actually mean by that?
Sure. So a lot of academics say it's a random walk, and whether we go up $1 or down $1 is always the same, right? It's always a 50% equal chance, or so they think it's perfectly efficient whether we go up $1 or down $1, it's always 50%. And so what I would argue is there's certain spots where it's not random. So take for example, I mean, this Lumen chart that I even already have up from the other video I was recording. When a stock gets this extended, I would argue that whether this goes up another 50 cents versus down 50 cents is not going to be 50-50 anymore. It's too overextended. And the more overextended and sharper it goes, the higher the probability of a retracement becomes. And so therefore, now think about this, like if we really say this super shot up to 380 super quick, I would argue the chance of retracement if we go to 380 might even be like 70-80%. And so guess what? Like even if the reward isn't that big, which I would argue the reward would actually be enormous. But even if it wasn't, my odds are way better than 50-50. So the reality is in the trading world, in like if I type up a random ticker, like let me type up, Ford on the same moment in time. Ford this day is just, this to me is total noise. So if I were to place some bet at 1086, I actually don't have any idea whether we're going to go up or down. This to me is 50% chance. Like maybe there's a 50% chance I make 10 cents. Maybe there's a 50% chance I lose 10 cents. Like I have no clue in this ticker. And 99% of the places, even if I type up General Motors. Like this chart to me is just total bullshit. Like there's nothing meaningful going on. There's no catalyst. There's no volume. So I have totally random luck on this. But there's going to be places with very specific things going on and really crazy patterns where I start to have better than break-even odds, not only just the odds, but better than one-to-one reward to risk as well. But keep in mind, there's tons of places where I might be willing to risk, willing to risk $1 if I might only make 20 cents, if I know I'm going to make it all the time. I mean, one great example is like take a merger arb, right? So this Kellogg is in talks to be bought by Mars. And this is another question I got on the Patreon. So there's going to be merger arb firms that buy this stock trying to get the closing price, I think is like 83 something or other. And 95% of the time, they're probably going to win. But if they lose, they might lose a huge amount. So like there's different ways in trading. Now, vice versa, there's hedge funds that they might bet on fat tail risk. So they might lose a little bit all the time, lose a little bit, lose a little bit, lose a little bit. But then when you get weeks like the middle of August, that panic, they make a huge amount. And so that's, I think, the point I kind of want to stress here overall.
Okay, cool. So you're saying even within the setup and when you have all those variables that kind of give you that edge, even within that, it's not always the same.
Exactly. Yep. Because there's trades I do that are lower probability, but really good reward to risk. Then there's trades I do that might be very very high probability. But the risk might even be greater than the reward sometimes, but that's still a good trade.
Got it.
Yeah.
Thank you.
Yep. So let me go off the top of the list of some questions. And so the first question, and feel free to interrupt at any point if there's better stuff out there. But one of the first questions was actually about burnout. Have I felt burnt out? What do I do when I can't give 100%? And do I tend to take it easier? Do I take the day off? Do I still review and stuff? And so I think the reality is everyone struggles with burnout at some point. And I think my trading psychologist, Dr. Katz, does an amazing analogy where so often, if you're running a marathon, the time to drink water isn't when you're dehydrated, right? If you only drink water once you're dehydrated, it's already too late. The damage is already done and it's way harder to reverse. So I think first step for people to recognize is once you're super hardcore burnt out, like that's super hard. Like when you're just totally zero motivation and you're like, oh God, I hate this, I'm miserable. You almost want to be more proactive than that. And so you want to ask yourself, like, am I feeling refreshed? Am I starting to approach burnout? Am I starting to get thirsty? Do I need more of a break? And so there's tons of times where if it's slow, my work ethic, if I'm feeling burnt out, is going to be way less when it's slow versus when it's really active. There's some times when you're going to need to burn the candle. So you always want to leave some in the tank. And so the other thing that I think is important is I have my all-in routine for when it's super, super active. When it's super active, I might be trading all day. I might be prepping pre-market. I might be doing review videos. I might be watching the tape. I might be studying all these charts. But I also have my routine that I kind of call like the minimum bare bones routine. And so that bare bones routine might look like for me, it was no matter what, I will always do a daily report card. That doesn't mean it's going to be the most in-depth, amazing daily report card. It just means no matter what, if I traded that day, I will get something sent out for accountability. I will still build that habit. I will still snip a couple charts. And so I know what my all-in routine is. Then I also know what my bare bones routine is for when I'm feeling burnt out. And there's going to be times where you need to push on the pedal and be all in because it's super, super active. Then there's going to be times where you recognize like, look, most summers tend to be slower. I'm going to take it easy around the summer. I'm going to plan some vacation time. A lot of times around Christmas and New Year's, it tends to be slower. And so a lot of times I try and use the slower periods to make sure I really, really recharge. That doesn't mean I don't do anything, right? I'll still make sure I'm studying. I'll still make sure I'm doing the daily report card, but I essentially have a very proactive approach to making sure I don't get super, super burnt out. Because once you're super, super burnt out, it's just so much harder to recover. And a lot of the times, if you're burnt out, it's just like, okay, I need to just take a total disconnect and go on a vacation. And so if I was burnt out, like I would definitely start to cut back on some of the hours, like especially when things started to slow in 2021. And I had been putting the pedal to the metal for so long in 2020 and 2021. That is when I started to say like, okay, I will not trade. Like pretty much I was not going to go to the office before 8:30 a.m. and I was not going to stay at the office after 5 p.m. Unless there was really something crazy happening, unless it was going to be a 100K trade or above, I was not going to stay at the office. That's not the right approach for all periods, but that was the right approach because I was burnt out. It was more important to me that I recover when it started to slow down than I keep on pushing. And also, if I'm burnt out, I'm going to just pull back on my risk. I'm going to pull back on my activity, and I'm going to do things that I enjoy. I'm going to step away. I'm going to get outside. I think being outdoors and active also helps. Does that make sense to everyone? Any questions on that first one? Getting a lot of thumbs up, Good. So, one thing on the chat, let me take a look at this. So one question was, one audience member has been in a bit of a drawdown and feeling some stress because of it. It's not stress in the moment from taking a loss, but the constant stress of it being hard to shake. How does one deal with that? So one thing that I think is super important, because I've seen a friend also go through or is going through like a tough situation. It's so important to, and I know this isn't quite the question asked, but it's so important to live below your means as a trader. One of the worst things that can happen is you get all these external pressures, right? If you have a family depending on you, if you have mouths to feed, if you have, oh my God, I only have 2 months left of runway at this job, that adds all these external pressures that makes a really, really hard job even harder psychologically. And so one thing, anytime you're in a hole, like a lot of the time is you just can't allow yourself to get into mental quicksand. You can't allow yourself to get pushed off psychologically. And a lot of that is by really focusing on the process and just saying like, okay, I'm going to draw down. What caused that drawdown? What caused these losses or the string of losses? What can I learn from it? What can I do to improve? Another thing is I have what I think, even though I did this a couple of years ago, this video is still amazing. It's not BS. Just Google S&B Capital, YouTube, Lance, drawdown best practices. I often retweet this. That drawdown best practices video is a really, really, really good video that I always recommend to people. And like, without a doubt, we're human beings. When you're in a hole, it's always going to be intimidating. If you've been in holes in the past, I urge you to say, hey, look, I've gotten through this before. Like once you've gone in a hole and out of it once, like you know you can do it, and a lot is just then always focusing on singles. You want to focus on the process, you want to size down, you want to really find the easy money ops. And something Bellafiore is really good about is, and he always says this, is like you always want to double down on your best practices. Like if you're in a hole, you can't afford to not be getting good sleep. You can't afford to go out and have a couple drinks during a weekday. You can't afford to do things that are going to impact your performance the next day. And so just finding like, okay, I need to be A plus on my routine. Like I'm not gonna mess anytime I'm in a hole, I don't like it, right? It is stressful, it is psychologically demanding. So I know that I don't want to be in that position. I want to minimize that time. And I know that the best path to that is doubling down on sleep, not drinking during the week, hitting the gym, getting morning sunlight, feeling good, following the process. And then ultimately, if I'm doing the things I need to be doing, I just recognize that, like, look, I'm controlling what I can control. The last thing I need to do is to put more pressure on myself or overly obsess about it. Like I don't need to have this spreadsheet of how much I'm down. I don't need to keep this tally. All I need to do is say, like, look, Lance, like you're a good trader, you've got a good track record, do what you're supposed to do, hit a single today, no unforced errors, and just follow the process. And that's kind of like my best advice, along with watching that video. But ultimately, I would also say that, like, being a stock trader, it's being in a drawdown is actually just part of the job. Like, not that it's fun, but a lot of times when we do well, and we're being compensated for having put up with such psychological difficulty of getting to that place and still being in our seat. So they're not fun, but ultimately it's something that we can just like deal with our head high, and the process helps us do that. So let's see. Some other questions. Do I have any ideas on how you can work on the accuracy of recognizing the expected value of a trade, essentially weighing the nuances and adding the corresponding letter grade based on that? Yeah, so that's a good question. So part of like refining your expected value and your like at the end of the day, it's always our estimation, right? Like usually in our trades, we have a stop. Usually in our trades, we don't necessarily know how far the trade will go, and the probabilities are certainly often always the hardest. And so how can you work on the accuracy? So I think one of the best things you can do is just obviously be databasing a lot, or even just trading one share a lot and keeping track of some of this stuff. Like the more you database these different patterns, the more you get different examples of what works and what doesn't work as well. The more you trade one share or even just paper trade or whatever, the more data points you start to get. And over time, you start to build this framework of like what's good, what's not. Like, okay, why do I not feel LUMN, that LUMN example is 50-50? Well, because I've traded so many of these and I know how sharp that pattern is, and I've got a good database. And you trade enough of these patterns where you can either crunch your data or you keep track of the data and you can then test that. And here's the thing is, if you think a trade's really good, but then you start to collect like 7, 8, 9, 10 data points, and all of a sudden, like if you crunch that data and it's not so good, then you're probably off somewhere, right? And so a lot of it is just you're kind of always tweaking over time, right? Like if I think 10 Jack is a decent hand and I'm playing 10 Jack a lot, and I just find myself losing with 10 Jack again and again and again, it might not be the worst hand, but it's not good enough to make real money. If I find that over time, like I'm playing queens and like, okay, I'm able to keep on winning these pots with queens, then guess what? I've got that data to back it up. What's so hard about trading though is every play is a little bit different. So that's what makes this so hard. Like if I could just have some magical software program that could compute me the expected value in any moment, like trading would be solved. What makes it so hard is much like at poker. It's not just the odds of your hand, but it's interpreting all the little things. So, I mean, there's the best way is either, databasing charts, tracking with one share or 100 shares or whatever, and then just looking at your own trade data. Where am I making money? Where am I losing money? Sometimes you'll be really surprised, but the data over time does not lie at the end of the day. You know, like a lot of people will ask me like, oh, how do you know you have edge in this strategy or that strategy? And it's like, well, I've been trading it for almost 15 years now, and I've got the P&L data, you know? So that stuff matters. One question, and I won't go too deep on some of these just because we've also got a huge list from the Patreon too. But one question was, can you talk more about applying options to trading? How do you think about when to express a trade through the stock or through the options? And if you're using options, how do you think about picking the DTE/the strikes? I mean, really kind of like an infinitely long video could be done on this, like something way beyond the scope of what I'll answer here. But what I'll simply say is like, it all comes back to expected value at the end of the day. So with an option, like expected value drives everything. So when I'm deciding for an option versus otherwise, I'm just simply plugging the math into that equation. So if we were to take something like SMCI this year and the 0 DTE opportunity back on 2-16, you can plug in, especially if you're being long premium, meaning you're buying a call or a put, you're able to figure out like, what's my max loss? What's the cost of this contract? If SMCI really does collapse, how much would that put go up? And what probabilities would I assign to that happening? And so in the case of SMCI, if I'm, when this stock starts to crack, I might need to risk, I don't know, 50 points in the equity. So if I'm risking 50 points, the max I'm able to make is maybe 4-1 or something like that. If I'm able to risk like $4 or $5 on a put, that offers a huge amount of skew. So that's one way. So now another way I can think about it is, let's take something like, I don't know, something like maybe Micron from back here. So this Micron was decently extended, but nothing super crazy. I wasn't so confident that Micron would pull back super hard, let alone just all the way back. And so when I was debating whether I wanted to be short equity or short a call, I ended up doing both, but the calls were appealing to me because I wasn't so confident that this would pull back a ton. Like, yes, it did. But what I did know is if this continued to go higher, I wouldn't mind being short. And I felt that there was a decent probability that this stayed flat. So if Micron stayed flat, I would make $0 on the equity, but I would make 100% of the call that I sold short. And so essentially, like, based on your view of what the stock might do, which kind of comes from experience and knowing the patterns, options allow you a different way to express those because they offer either different win rates, right? In the case of selling the call, that's a way higher win rate than being short the equity. Or in the case of SMCI, buying the put offered way more reward to risk. And the other question was, how do I think about days to expiry and the strikes? This is also pretty specific, and it depends what you're trying to do. My general rule is I never go super far out in time, just because that opens you up to a lot of randomness. And I generally am using options to make very specific bets in time. So like if I don't want to sell a call, here for December, because I don't know what's going to happen over the next 4 months. I'm not so confident that Micron might not do something amazing over the next 4 months. What I was confident in is that if this Micron spikes for another week, I definitely want to be shorted because that's just a massive move on no news. So that's kind of like, in general, I'm sticking to very near-term expirations. And for example, like I'm only using a 0 DTE if I'm very confident it might make that move today, right? So this day, despite it actually melting, I wasn't super confident. And I don't think there aren't 0 DTEs on Micron anyways, but like take even IWM, which I did some options with. Like if I'm super, super confident it's going to melt, I'm going to buy a 0 DTE put. But a lot of the times I'm not necessarily confident it's going to melt, just that we might not go higher. So that's how I'm kind of trying to align things, and you get a feel, because with different strikes, there's different trade-offs. If you're long versus short. So that's kind of my short answer, just because for me to get in depth, I would probably need like a 5 hour kind of TED talk. So another question in here was, for some trading strategies, it may work in certain market conditions and not so well in others. At what point do you stop using certain strategies which have been working well but stopped working as well? Or do you tend to only focus on developing on strategies that tend to perform the same across all market conditions? So this is a good question. So I'm not looking, like, if a strategy only performs during certain times, if it makes me money, who cares? I'm totally cool with that. Like, a strategy doesn't need to perform all the time, right? There's times where you can have a really, really hot IPO market, and overnighting strong closing IPOs has edge in those markets generally. Like, that doesn't work all the time. It only works under specific conditions. I'm totally cool with that. There's other strategies that kind of go in and out. Like, there's times when low floats really tend to squeeze. There's times when they retrace very well. So at what point do you stop using certain strategies which have been working well but stopped working as well? I'm just constantly listening to the data, right? And this is an important point that's worth emphasizing. The most recent data is always the most important. If I've done a trade 100 times or 200 times and it has a 90% win rate, and then if all of a sudden that trade loses 8 times in a row or loses 7 out of 10 times, that's like major, major red flags. And I can't just say, oh my God, but look, it's still been good the last 200 times. The most recent data is always the most important, because otherwise you're just going to be so behind on any changes to the market. And that doesn't mean I'll not do the trade or never do the trade again. It might mean that if my recent data is starting to turn, I might start assuming the issue isn't with my selection. If my data is starting to get worse, I'm definitely going to take my foot off the pedal, and probably be more selective in the setups, not just more selective in them, but I'm also going to size them less. So there's no perfect answer as far as like, oh my God, after 3 strikes and you're out or something. But even after a couple losses in a row, I'm definitely probably being wary. 1 loss is never enough to conclude anything. Even 2 losses isn't much. But after, like, especially talking 3, 4 losses for most strategies, right? Because again, there are strategies that lose 9 out of 10 times, so that's different. But for most strategies, if anything's starting to stray from the data after a couple data points, I'm going to really start to take defensive action and be more selective and size down. Let me pause there. Any questions on any of that before I jump back to some of the other questions already posted? Hit me, Robert.
I'm gonna take advantage that you already addressed a question about the classification of trades, because that was one of my questions on the Patreon. So I'm gonna be more specific on the question because it's about the variables, the parameters. So the question is, what variables, parameters do help to Lance Bradstein to differentiate between an A plus trade versus B, C, etc. And actually, you already showed, for example, okay, SMCI was an A plus, and you wasn't an A plus. Even the setups are kind of rhythm, they are very similar, but the expected value was very different. So my question is that, Lance.
So here's what makes a lot of these answers hard. It really depends the setup. So there will be times where a trade is absolutely amazing because of the daily chart. there will be times where a trade's absolutely amazing because of the level 2 box, right? So if we take, you know, GME back here, I know I've done a bunch of videos on it. Like part of the turn in GME here on this 6-7 day was because of the level 2 box and that ARCA buyer that was there. So a lot is very play specific. There's going to be times when the level 2 doesn't matter at all. And so let me give this analogy. It's like asking a poker player, like, what gives you the most confidence? Like, obviously the cards matter. And the cards I would equate to just being the chart, right? So of course the cards always matter, but there's going to be times where someone might have mediocre cards, but because of the player they're playing against, it's so obvious that like, oh my God, this guy's bluffing or something. And you know that this guy's going to fold. And so there's times when you can have a really good play, not because of the cards in your hand, not because of the chart, but because of the level 2 box or something, or because of some other nuance. And so there's some plays where SMCI was amazing because of the daily chart and it had a good intraday. Then there's some charts that have a really, really good intraday, but just an okay daily. And so what I'm really doing is there's all these different variables. What's the level 2 box like, if relevant at all? What's the daily chart? What's the intraday? And in my head, I'm almost like rating them each 0 to 10 or so. And it's like this weighted average. And so there's going to be, in general, as an intraday trader, I would say the intraday chart is the most important. So if you forced me to say a generality, I would say on average, like the intraday chart is probably 60% of it. On average, the daily chart is probably 30% of my decision weighting. On average, you know, the box, the level 2 box and the market context is probably 10% involved. So it's really weighing all those things. So then of course, if there's news headlines and everything else, like, so that's actually a great example. In a news stock, in a news headline, like I might not care about the daily chart at all, right? So if we take this Oracle, because I just did this for the monthly top op. So let me go to this 7-9. Actually, you know, I don't even need the intraday. So what ended up happening was it this day? Don't quote me on this, but on this day, Oracle had a headline that they were in talks with Elon Musk's xAI for a $10 billion cloud deal. And we went up a bunch of percent. Like I think it went up like 5-6%, right? So here back on July 9th, the headline came out that talks ended for that deal. So I don't care about what the intraday chart looks like before that headline. I don't care about what the daily chart looks before that headline, and I don't care about the daily the level 2 box. All I care about is this headline that sent the stock up 5-6% is all of a sudden totally negated. So like I don't need to be like, oh my God, the daily is XYZ. All I'm doing is immediately trying to short, because in a breaking news trade, that's the most important. And so, yeah, so that's going to be one factor. So now let's jump to something like Bank of America. As you guys know, Bank of America was my sleeper pick for that panic. I knew just based on this daily chart, like there were some prints pre-market, I think down at like 34.30 or something. I don't care what the intraday looks like as that's happening. Like this daily chart, for this to go to 44, pull back all these days, then panic all the way down to like 34, whatever. Like, I don't care. That daily chart to me is so good that I'm buying it. What actually happened was it was one seller pre-market, as I discussed in that other video. It was one huge seller selling that. So when you tell me this is the daily chart, plus it's just one seller, like that to me is just like, it's just a no-brainer. Like the daily chart is a 10. The level 2 box is just one seller just driving it lower. That's also a 10. I don't care about the intraday. It's pre-market. There isn't much of a relevant intraday at that point anyways. So it's not like I'm not trying to like cop out when I'm saying it depends, but that's like part of what makes, there's people that that kind of bullshit you by saying, "Oh my God, there's no right answer," because they don't know the answer. Like there's some stuff where like, you know, if you were to tell me in tic-tac-toe, oh, what plays best, there's probably a good answer to it. But trading is actually one of those things where it's complex enough where like it really does matter a lot of the setting, what type of trade. So even though it seems like a cop out, I promise you it's not, and it's just it really depends what trade we're talking about. Does that answer that and make sense to everyone?
Oh yeah.
Good. You know, because like I think this Bank of America is just a really powerful example like that. Like if I don't need to know what this intraday chart looked like at all to just know that anything in this range is going to be probably a really, really good buy. But if you showed me, you want to know what's a good example? This Tesla, and I just did this in the top ops video, which still needs to be edited and stuff. On this daily chart, this stock's just going up, right? So what happened though is on 7-3, there was a really good intraday move where we had multiple legs. And 7-3-2024. Okay. And so what happened on this intraday was we made one 5-point leg, consolidate, we break out, we make another 5-point leg, we barely consolidate, then we make almost another 5-point leg. So we get 3 legs in a row. And like, yes, the daily chart is good and overextended. But like, I'm not going to wait for us to break the trend on the daily just because this intraday is so good. And like, there wasn't anything that meaningful to me on the box. So like the level 2 box on this specific trade wasn't that interesting to me. It just wasn't important to me. So those are a couple examples of how I'm thinking these through. Good from everyone. Good. Thumbs up. Let me take one from some of the pre-requested questions because I think this is an important one. And so this was from Coleman. With breaking news trades, quite often with biotech stocks, when a positive news is released, the first bar spikes up according to the news, but then you get a spike down below the unaffected price, but then it goes back up in the other direction. And so this person finds it quite difficult to stay in the trade or manage risk when this happens. There were a couple examples. This SLRN was one on the 13th post-market. Let me see if I can pop that up real quick. Yeah. So, oops. So this was the 13th. And so, yeah, as you can see here, we spray up, we spray down, you know, then we kind of go. August 9th, SPRY is another one. August 9th. So that's back there. And so the initial movement of the stock is almost like spoofing. So I wouldn't say that's really, you know, be careful with the words because that's not really technically what spoofing is. But I think a lot of times what happens is just like some of this stuff like can just be super shaky. And so my question is like, I guess I would almost reverse the question and say like, when things do trade super choppy, like let me go back to this SLRN real quick. Like this thing is indeed super choppy. And so like, how does one manage risk? Like if this shoots up, then it goes down, then it goes back up. Like some might be tempted to hold through the shake. In general, that's not something I want to be willing to do because I generally want to stop and I just don't like that trading. And I think the better question might be like, if things are going to be this choppy and this not clean, does one need to capture these at all? Like there will be times when these probably trade cleanly. Then there's going to be times when these are super choppy. Like for me, anything that's doing stuff like this, I don't need to get involved in at all. And so like one example is on a lot of times on Fed meetings, unless it's super, super offsides where it's some decision where it's super clear cut and binary, a lot of Fed decisions initially can chop around in the beginning. And so like rather than ask what's the best way to trade that chop, I say, wait, I don't want to trade that chop at all. The only times I'm going to trade that initial Fed decision is if it's super, super clear cut, binary, and someone's off sides, right? So if everyone's expecting a huge interest rate raise and the Fed stays the same or something, I'm going to trade if it's super off sides. But if it's anything around expectations and we're just going to chop, I try to avoid that. And so like anything that's trading like this, even though we go back higher, like I just need to be okay not being involved at all. Like for me, anything this choppy is just stay away. So like it just makes it hard to manage risk. It makes it hard to argue that there's really, really good expected value and very defined trading here. And this will change over different markets. Like sometimes stuff can be super choppy. And then you just got to say, look, I'm okay staying away. So that's my answer to that. Any quick questions before I keep on plugging away at these? Or was that good? Okay, cool.
I have another one. I have like 1,000.
Hit me with
Well-
one then I'll get some of these other
Yeah.
ones.
Speaking of breaking news, Lance, and you know I'm very into that. What do you think about the headlines awareness? Do you want always to be aware of the nuances of the words itself in the headline, or just by knowing the type of headlines? Okay, this is an M&A, this is an offering, this is, I don't know, bankruptcy. You have a couple examples of that on the monthly
Yeah.
ops.
Yeah,
You go and check the other stuff, volume, the tape, and take the decision. So
Yeah, no,
what's
that's actually a really, really good question. So there's a couple ways to go about this, and this is where a lot will depend the person's skill sets, right? So the most simple way, and what I would advise for most people, is to view news as binary, meaning there is either fresh news or there isn't. What are the implications of there being fresh news? In general, if there's fresh news, that tends to lead to fundamental changes in the value of the company, and it can really lead to trends and continuation. So in general, when there's news, just in general, I want to tend to be with the trend. When there's not fresh news, if something makes a big sharp move, I might be thinking more mean reversion. So for most practices, just simply knowing there is news, in binary terms, yes, there's news, or no, there isn't, is very, very important to me. And that will affect my trading style. So if we were to just use that as a basis and like, okay, when there's fresh news, I want to find a setup that helps me go with the trend and capture that next leg, that's great. If we use that as, hey, there's no news, I can now try and mean revert this, that's awesome. That being said, if you have expertise in certain pieces of news, you can start to be more granular with it. You mentioned stock offerings. So what you can do is there's going to be people that really study stock offerings very much in detail. They study what stock offerings tend to have the biggest effect. What are the variables involved in stock offerings? So some variables, stock offerings is something I've studied. So some of the variables are, how big is the offering? How big is the offering in relation to the market cap? Where is the offering priced versus the current market value? Are there any weird things like also maybe there's convertible notes, which can be converted into stock? What is what is that offering being used for? Is that offering being used for something super, super bullish? Generally no. So as a rule of thumb, like in low float world, if you get a really, really big stock offering, a lot of times those stock offerings can just be game over for the stock. Man, I don't remember some of the tickers off my head, but there was one I did last month's top ops where there was some big offering and it was just like, oh my God, that offering as a percent of the shares of float, the shares outstanding is so huge where it's just like this is game over. Like even take GME. So take GME. Oh God, what day was it? I think it was this day, right? Where they bagged Kitty. Where pre-market they announced that huge offering. This was the day they bagged Kitty pre-market, where they pre-announced or pre-released their earnings so then they could do that offering. That offering. So like, first of all, the second I heard there was an offering, that's just go nuts, short the shit out of it as quick as you can. Then once I had a few minutes not even minutes, but a couple seconds to process how big that offering is, that offering was enormous. So that to me was like, wow, big picture, this is game over for the stock. Like, I'm not saying it's going to go in a straight line, but that is like a massive amount of overhead and shares increasing. So stock offerings is one example where I'll do a next level of analysis. There's also times in M&A where M&A is something I've studied more granular. M&A is an area where I will parse every single word in the headline. I will parse every single word in the article, and I will pay very close attention. For example, I know that M&A in biotech is way more of a big deal than M&A in oil and gas or in financials generally. I know that advanced talks are much bigger of a deal than preliminary discussions. I know multiple suitors is more of a big deal than, hiring an advisor. And so I've collected endless amounts, hundreds of data points on stock offerings. I've collected hundreds of data points on mergers and acquisitions. So that allows me to get a feel for what is where these things might go beyond just there's news or not news. And so for most people, it's like just knowing news versus not news and knowing the implications of that is a big deal. Then if you want to become an expert in certain different areas, hey, more power to you. There's people that have relationships with all the bulge bracket banks. And so as a result, they get all the sell side research reports. And there's people out there that have a really good feel for this is the axe in the name. This is the axe analyst that moves the market. This is a really bullish upgrade. This guy had a sell on it. Now he's going to a strong buy. Oh my God, this is going to really move the stock a lot. And so that person has edge because that's something they have access to and they have data and everything else. And so that is how, like, that's what's so beautiful about markets, right? Is like, for some people, news might not affect their trading at all. For me, it certainly does. There's areas where I really care about the details, and there's areas where I have no expertise at all. And I'm sure there's people out there where they might be experts in biotech data. They might be experts in court rulings. They might be experts in who knows what. So that's how I think about that different stuff. Good.
Gold and diamonds. Thank you.
Well, just diamond hands it then. So thank you. So Drew had asked a question from your daily report cards. Can you talk about using a risk manager / accountability manager? What worked and what didn't? How have you seen pods utilize this approach? So pretty much my trading, especially towards the end of my career, was pretty large size where like it was beneficial. Like the firm had a risk manager, but like that risk manager had a lot of other duties and is managing the whole firm. And it's not someone, plus he was, New York based. So it's way different than having someone next to me that I can just like debate to, talk to, help me out in different trades and stuff. So what I ended up doing was I ended up essentially hiring someone for the Chicago office to help me manage my risk and just be accountable in all sorts of different ways. What worked and what didn't? In general, it was probably pretty good overall. Like just having those check-ins and just having someone as like, hey man, like, what's the plan here, I think is good. What makes things very, very hard is sometimes like risk does kind of need to be subjective, right? Like there's some days where you really do want to risk more, and it's not because you're on tilt. It's just because like the day actually truly justifies it. Like when I went super, super huge last week in NKD. Like right now, I obviously don't have a risk manager just because I trade on my own. So there was no one to be like, hey Lance, what's the plan here? Hey Lance, how much are you going to risk? Hey Lance, are you sure you want to be down? I was probably down, I don't know, maybe like 1.5-ish or so at one point. And there's no one saying like, hey Lance, like what's the plan here? Or like, hey Lance, do you really think it's a smart idea that you're not going to sleep for like a day and a half? Like, aren't you already really tired, Lance? In which my answer would have been yes. So like my trading I'm very much aware that I don't have someone having those conversations with me, but I'm also aware that like there are times when like it was not a mistake for me to be risking a huge sum of money on that Sunday night into Monday. That was not a mistake. That was a very intentional decision. But there are times where even I get tilted. Or there's times where I do super dumb things now, like like this was a funny one, and this is a true story. So this ASTS was going on Friday. I think this is just not yesterday. This is like 2 days ago because today's Sunday. And I was watching this ticker. And so I had a golf lesson, I think at like 10:30 Eastern time. And so I saw this melting. And, first of all, I think this was an interesting short that I'm sure I'll cover in next month's Top Ops. Or someone might have also asked a question on this, so I might get to this later. And so I saw this melting like this. And so then when we broke prior bar highs, I ended up buying here. But I had a golf lesson, right? And so that's something where it's like, I'm kind of relying on myself to be like, hey, Lance, like, are you sure this is the smartest thing? Like, you're not going to be able to watch it. You're not going to be able to focus on your stock or the golf lesson. And that's where like Lance needs to be like, hey, dummy, like, like one, you like, what are you doing, man? Just like enjoy the golf lesson, enjoy the nice day, and just get out of the position, right? So I do think it's like, it's harder to always be on top of yourself. As far as the question of how have pods utilized this approach, I think that's such a really, really good question. That's a good question. Because in general, I think like a lot of the pods that I deal with work at firms, whether it's Trillium, SMB, or like a couple other firms out there. A lot of them kind of just have built-in risk managers. So how can you all at home apply this stuff? Well, here's a question. Like, I've seen pods do the type of thing where they tell each other their game plan beforehand. I will only trade A, B, and C under these situations. And then you hold each other accountable to your game plan. Or you say to someone like, hey man, I didn't sleep so well last night. I'm going to need to risk down and take it easy. Or, hey man, I'm on a bad streak. If I lose another day, you got to cut me off. And so I think there's ways to communicate this with each other. You could also go as far as sharing your P&L live with each other so that you can have each other accountable. The one downside of that, of course, is like if you all are getting in the like blown out in the same trade together, it's going to be really, really hard to all save each other together. It's like if I'm busy fighting for my life, I'm not going to worry about your life because we're all drowning. So that's Robert. Did you have something you want to throw in there?
Just a question, very quick question, because you are touching that topic already. How would you prefer a pod? All of the members oriented to one type of trading, for example, five guys doing breaking news, or a very diversified pod, the breaking news guy, the backside guy, the momentum guy, the scalper guy, the swing guy.
I mean, I think they both work. They both have pros and cons. I don't think there's any right answer. Like I think if you're someone trying to learn a lot, like obviously the more diversified pod is going to help you learn and broaden your horizons. So like you know, especially in the beginning, it's probably good to get diverse opinions. Like for me, I'll be honest, like I don't really have much interest. Not that I'm closed-minded. Like I don't want people to think I'm closed-minded. Um, like it's not that I don't want to learn other things, but like learning new strategies, it's just not something that interests me or I have time for. Like it's so like for me, anytime I trade with a group, it's people that are like know what I'm doing and what I'm looking for, and like they're just covering my ass and doing me a favor generally. Like on that Monday, after whatever that day was, August, whatever that the you know where I stayed up all night, like that next day, I hopped on a call for a couple guys, because one, I don't have my full suite of software anymore. Then two, I knew I was extremely tired and was just going to be like lying there half like in a coma. And so that was something where it's like I need people that are looking for exactly what I'm looking for, and they're going to be calling out exactly what I'm interested in. So like for me, I'm just trying to execute and perform. I'm not trying to learn new stuff. I don't have capacity to like spend time on this. Like you know, so like I'd say both models work, and it's just kind of what you're into in your trading career and everything else. But to Drew's point of like how can pods utilize this approach, like I think it's a good best practice to just check in with everyone. You know, like you can make it, you can set an alarm 9:20, nah, maybe not 9:25, but like maybe 9:15 each day. You check in with your pod. Hey guys, how are we feeling? What's our risk? What's our game plan? What traps are we trying to avoid? Maybe you share each other's P&L with each other, so you can say like, hey man, like you seem to be churning, or like you know, just setting rules of, you want to know what's not the craziest idea ever, like not for beginner traders, but if you're like five really good retail traders, it doesn't strike me as that crazy to get some type of like maybe group risk manager. Like at a certain point, you have the scale to pay someone to be like, hey man, this is when we need to intervene and need you to intervene. This is how we want you to intervene. This is a conversation we want to have with you. One other thing that makes it hard too was like there's always a conflict of interest when you're the really big trader or you're the boss, and then like there's a hierarchy that makes it really difficult for a risk manager to enforce the rules or speak back to you and everything else. So like it's a very delicate relationship, right? Because you want someone that's going to handle things appropriately and not be afraid to say like, hey Lance, like look man, like these are the rules, you're messing up, I'm sorry, you know, I got to cut you off, whether you like it or not, whether you throw a hissy fit. So those are some other things that make it hard, but I think there are ways to think about like how might this apply to our pod. um I hope that makes sense. Let me also get to this part too. Oh, so this was a good question that I have a great answer to. Drew also asked, what did you do to prevent giving back profits on subpar setups later in the day, especially when you were having a big profitable day? I cannot stress this enough. So many people, when they're having a good day, I think it's human nature that you feel like you're playing with house money, and it's so easy to get sloppy later in the day. So the number one thing I do is, first of all, I'm extremely cognizant and self-aware that when I have a really good day, everyone, probably nearly everyone, feels like they're playing to some degree with house money and get sloppy. So the first step is awareness of that. Being aware and saying like, whoa, like, okay, you know, we're past the open or things have slowed down. Like it's almost a good pod habit where it's like when things have slowed down on active days, it's not a bad thing to just be like, hey guys, you know, I feel like things are slowing down, to give everyone that mental cue of like, whoa, okay, I need to start to dial things back. Because most people will keep on over trading, or if they underperform, they're going to just keep pushing, pushing, pushing. The other thing I did is, as part of my daily report card, I would set a give back rule at the end of each segment. So I had these segments 9:30 to 11, 11 to 12, 12 to 2, 2 to 4. And so let's say 9:30 to 11 comes around and I was up 50 grand. I might say, okay, things are pretty slower now. I caught what I needed to catch. Like, I don't see there much being more opportunity. I'm going to only be willing to give back 10K. My give back rule is to 40K. If I hit 40K, you know, I'm done, or I'm hands off or something. If it's going to be very active later in the day, maybe there's like a quad witching type thing. I might say, hey, look, I'm up 50K. I'm willing to risk, you know, that P&L and $200,000 more, right? So like what I found was like having those segments on my daily report card and those check-ins multiple times per day allowed me to just be very conscious. And on good days, I would really tighten things up, like especially if 90% of the moves were done and I felt like, okay, like it's gonna be dangerous from here on out, I would really tighten the risk. So that's a good question. You're welcome, Drew. Let me catch up on some of these questions. It's so much different than when I did these Patreons or these AMAs with like 6 people, and it was just like way more casual where it's like, you know, I'd have like 3 questions. I would, you know, kind of tap dance and stall a little bit. Now it's like, oh my God, I can't keep up. I need a assistant just for the AMAs. So Dexter asked, I find it concerning that so many successful traders hurt their health, relationships with friends or family, or are constantly stressed out. Do you think not making these sacrifices will substantially decrease the probability of success in trading? You know, very important question. Like, everything in life is a trade-off at the end of the day. The question is finding the right spot for you and the right balance for you. So like, do I think if someone spends 2 hours a day working and 8 hours a day with friends and on health stuff, do I think that that is going to impair their learning? 100%. Vice versa, if someone is working 20 hours a day and sleeping 4 hours a day and not going to the gym, do I think that will impair their health and performance? Absolutely too. And so I think it's like, every person will have a different balance, but it's really about finding what the right spot is for you and recognizing that a lot of the times it's not mutually exclusive, right? Like getting good sleep makes you learn and perform and study better. Having going to the gym and being healthy and not sick all the time keeps you in the game, right? Like if I can reduce my sickness to 5 days a year rather than 20, that's a lot more extra learning, a lot more extra life, a lot more feeling good. And so stress, like most people are not going to learn or perform well when they're super stressed either. That being said, I recognize that like, this is a really hard thing. Like it would be foolish to say that it doesn't take massive commitment. And so it's more so finding that balance of how can I hit this super hard? How can I learn hard? And then how can I recover just as intentionally? So like, it's about finding how can I work as hard as I can while also finding fulfillment and not like sacrificing all of that. Because like at the end of the day, like if you sacrifice, like, well, keep in mind, it's also age and situation dependent. Like when I was 22 years old and I was, you know, like my main priority was work, and I think that's right. Like I didn't mind really burning the candle when I was 22 or 23 because the incremental difference to make some money versus having literally zero money can be enormous. And like I recognize that when I'm young, sacrificing a couple years, if I do well, I can have a lifetime of like health, friends, and family, right? And so I burnt the candle a lot, but I did so intentionally knowing that now I like guess how healthy I am now. I'm probably in the top 5 percentile or maybe even 1 percentile of people because I have the means and the freedom to be extra healthy. And I've made up, like, did I miss out on fun times with friends? 1,000,000%. The first couple years, I did barely anything. Like maybe I'd go out, like, you know, for dinner once a week or something. But I also just didn't, regardless, I just didn't have the money to do any of that anyways. I also think if you say have kids, the opportunity cost of missing your kids grow up is probably much greater, where like you value that and that's important to you and that's something you might regret, compared to like me being 22 and missing happy hours. You know, it's something I didn't care about. So I think it's like just reflecting on where you are in your life, and what the job means to you and priorities. And I think it's like then also recognizing that it doesn't, right? You can work really, really hard, but then still do a lot of these things, and just pulling on the different levers. Like right now, I would say I still work decently hard. Like I still work on a lot of cool projects, but health is a very high priority. I'm generally, like, as a general rule, I try to no longer work past 5 p.m. But that was not going to fly early on in the learning curve. And nowadays, like I think with time, you learn about stress and everything else. So I guess like that's a long-winded answer of like, I think sacrifice does need to be made always. But it's finding the right balance based on you and your values. And it's like there is some sweet spot where you sacrifice too much, where it's not even productive. Like if you're not getting good sleep and you're not able to just hit things hard each day, like it's the other thing too, also as a huge indicator, is if you're just not happy, like what's the point anyways? So if you're ever working so hard for a sustained period of time where you're miserable, then it would also cause some reflection. You know, like for example, there was one new hire at SMB, and he was working his ass off, and he was like, Lance, like, you know, should I be worried about burnout? Like I'm not doing like a ton of social things. But he's like, I just really, really love it. And it's like, look, if you're having fun and you're feeling good and you're content, like you do you. If you start to feel burnt out, like assess. And I guarantee you, you know, he's a young guy. His values if he's, I don't know how old he is, but if he's 22, 23, his values are going to be different when he's 33, 43, 53. And you know, if you're 93 or something, like, you know, it's a way different picture too. So yeah, that's kind of long-winded answer. Okay, we've got a question from Michael here before I jump back to the chat. It's actually interesting. A lot of these questions so far on this AMA have been more psychological based than trade specifics, which is a good balance from some of the other ones. As someone who turned good traders into great ones, what mental shifts or breakthroughs do you believe separate average traders from elite? I think one of the biggest differences that helps people go from average to very, very good is the ability to divorce themselves from the money. If you're always thinking of your risk in terms of everyday terms, it's going to make it really, really hard for you to bet big and size up. And so I've worked with a lot of traders where no matter what they do, they don't increase their bet sizing. Like for them, they always think, oh my God, $50 of risk is, oh my God, like that's that's dinner with my wife or something. I can't risk that. And I think the really good people are able to view this purely as a betting game and recognize expected value and internalize that. And so when I risk a huge amount in NKD or whatever, like I'm not thinking about, oh my God, Lance, like, you know, when I was down $1 million plus, if I think about, because most of the money I end up donating, right? So if I start thinking about like Lance, you dummy, you know, you could have just saved 200 plus lives if you didn't stay up all night incinerating this money. Like, what's wrong with you? Like, I can't allow myself to think that way, right? That's not when I'm playing the trading game, it's just a number. It's just a number on the screen. And my job is to make the best expected value decision. Once that money leaves the account and it's in the bank, then it's a different decision, right? Then I can do real things with it. But any number on my screen or on any good trader's screen, especially on the way to elite, it's literally just you're just playing a video game and it's just a number. You know, whether you psychologically need to lop a couple, like here's an interesting thing. Like, how would you act if you lopped off a couple zeros? Right? If you're worried about $50, okay, what would you make this trade if it was just a 50-cent bet? And that doesn't mean, you know, up your bet, you know, 200x, but just think about it. Like, you know, if if this was, if rather than risking 1.5 million, if I was risking 15,000, would I be super, super scared? What if it was 15 bucks? Would I be panicking, or would I think, oh my God, this is such a good bet? So a lot is being able to divorce yourself from that. I would say the other thing is just not having too many limiting beliefs. And it's not that people don't have limiting beliefs, it's that you need to work through them and figure out, is this rational or not? Like there's a lot of traders I've seen that have said, I can't do X type of trading, or I can't be fast like that, or I can't bet that amount, or I'm not good at that style. Nobody's born good at trading. Nobody's good at any of this stuff, right? It's no one, you know, with their caveman spear was like betting on a stock chart. Like it's just not an innate thing. And I do think a lot of this stuff can to some degree be developed. And so it's like having the belief that I am able to work at anything, like that growth mindset. If I work at this, I can get better at it. And not being limited by that. And I think the other thing that helps psychologically is when people really start to focus on the process. And I think that's what SMB really does a good job of, is like everything is so focus oriented, or sorry, so process oriented. And like the more it's hard when you're dealing with young guys in the trenches, just because sometimes you lack perspective. But the more you can just truly say like, look, the best path to success is me just focusing on the process and giving it my all. That's what leads to the best outcomes. And I think that's really, really important. How do you guide traders in identifying and sharpening their unique edge in the market? Well, I think a lot is just being true to like what your strengths are and what resonates with you. Why did I end up at Trillium rather than you know, Jane Street Capital or some firm that requires high programming? Because I didn't have super insane programming skills. I didn't have super insane quantitative math skills. And I just knew my strength was I was going to just outwork everyone. And I wasn't dumb. I had some math and stuff. And so I think there's people where it's like, if you're really good at programming, you can make a quantitative strategy. If you're really, really good at, I don't know, maybe you really enjoy making filters for different setups, and you can be a very technically driven stock trader. And so I think a lot is like, what do you enjoy? What resonates with you? Do you think buying a capitulation is the scariest thing in the world? Or do you feel more comfortable just buying with the trend, which I think initially is probably everyone because it's scary. But I think it's just, I don't know, like the contrarian mindset kind of worked with me. So a lot is just going to be like what resonates with you as you open yourself up to these things. For traders who are consistently profitable, what are the key factors they should focus on to take their performance to the next level? Like once you're consistently profitable, and if you're consistently profitable, I assume you have your own easy money trades. What I would say is you want to then find more of those trades and just really push size as like gradually and prudently in those trades. Most of the time, traders that have found some profitability, a lot of times they can just keep on doing what they're doing, but just adding size in a prudent, safe manner. How do you train traders to maintain peak decision-making skills during high stress periods, such as volatile markets or when experiencing a drawdown? We kind of touched on that at the beginning. Like, first of all, doubling down on the routine, especially on high stress days. You can't start like hyping yourself up. You know, you really need to follow the same routine. In an ideal world, like you get the right amount of sleep, you still stay in the zone. Whatever your routine is, ideally it's an intentional routine for a reason. You double down on it, you get the right amount of sleep, you get the right pre-market, you do the same work, and then it comes down to executing, right? Like how many people in the Olympics, how many of those athletes do you think did a different routine the day of their performance on the Olympics versus any other day? I guarantee you they did the same exact thing to help you with the nerves and everything else. And then just like, look, you're going out there to perform, let the chips fall how they may, trust in your experience and the process. What daily habits and practices are most critical for long-term success beyond just strategy and market knowledge? I mean, I think detailed write-ups are probably some of the best bang for your buck. What made the best move each day? How can I reverse engineer it? What are all the nuances that really, really helped me? Those are some of the best bang for your buck. Um, okay, so Kushal, just on the screen for ASTS that I had before, let me go back to that. Do you consider that mean reversion trade that you did as the dumb trade? I mean, I don't think either of these were dumb. I think both of those were good trades, actually. Oops. So I think this trade, oops, a little bit too zoomed in now. I think this trade was totally valid as a short. And I think buying this on the turn was also valid. So yeah, I mean, I don't think it was, I mean, this bar, like these two bars were not ideal, but that's a really, really big move for that to retrace like that. I only think it was dumb because I literally was, you know, supposed to be getting ready for a golf lesson. And like, I think generally if you can't monitor a trade, yeah, you probably shouldn't be in it. But no, I don't think, you know, I think the short was probably better than the long just because we were pretty extended on the daily. But I mean, both were pretty worthwhile to me. One other question from here, healthy versus unhealthy pullback idea is new to me. Wondering which cases you might want to assess the grade of a pullback. Also wondering if we could go through a few examples and talk about how much they affect the thesis. Sure. So I mean, it never, like, one thing is like, it's not a bad idea to just constantly type up charts and just see like what's interesting about them and grade pullbacks, grade the chart, whatever. So I would say this sharpness on Micron, that's a bad bar. So already we've retraced so much, that's very bad. Like, so as far as like being a healthy pullback, this gets a D. Once we break the moving average and we're 100% of this move retraced, like this is an F of a pullback. Like nothing is going to make me in the near term interested in this long. And it's going to have to prove a lot for me to be interested. Now, if we compare that, now if we compare that to NVIDIA, so this was kind of the equilibrium. This is where we broke out to. So this only retraced probably about, I don't know, just maybe like a third, right? If my base case is a 50% retracement, this retraced a third, then we hold up pretty well. Like we hold up then above the moving average, we push up towards these highs. So I'd say this is maybe like C+ or something. And what about if I go to, I'm trying to think of what might be a really good one. Did ARM fare better? I want to find a stock that, what about, no, this isn't what I want. Okay. Let's go to Tesla on 7-3. 3. 7-3. Okay. So, oops, just messed that up. So this, I would say, is a really healthy pullback. We go $5, we pull back $2. So I guess if you think about it, that's like a, I don't know, 40% retracement. But then we consolidate to the moving average, which is really nice, and we start to tighten up. So overall, like I would say this retracement, like this gets like a probably B+ to me. If this bar held tighter, that would probably be maybe an A-. And so what's also important, and I think is a good idea, is to always have an idea of the extremes. What is the worst consolidation pullback ever, and what is the best? So the thing that I always use as an example of the best is if you were to go back and go to this 11-29 intraday. So we're gonna do that. So let's go to 11-29. And this is stuff you want to just put in a notebook, right? And like, here's a great exercise for all of you. do healthy versus unhealthy notebook or healthy versus unhealthy pullback, make a notebook in Evernote, then just put like 40 charts with different consolidations and just put them and rank them in that notepad in Evernote. Like that's an amazing exercise to do. So then you can really distill it in your head. So if you want to see what an amazing consolidation looks like, you know, this stock made a pretty big move, right? We go from 11 all the way up to 20. We hold in the upper quartile. That then tightens up, tightens up, tightens up. Then we break out. So that's a really good consolidation. It was for many hours. I get tighter and tighter and tighter. Any of those bouncy ball setups, like I know I've done them before on Nikola. I did one on Ford. Let's see, can I find the Ford? Oh, I think it was this day. So 1027. Let me see. 1027. 1027. Yeah. So this makes a big move. We have a bounce. We then have a little weaker leg. We come down, little weaker bounce. So this, to me, oops, is like, this is a really good consolidation where we get weaker into the break. I wouldn't say this is best ever, like the VVOS is even tighter, but this is a good one. So, and I would just do that as an exercise, and then you can just figure that out. And like over time, you can see like, does this stuff pan out? So Carl said GNLN on 8-12, what I say is similar. Let me see this thing. Oops. 8-12. So this day, 8-12. Is this the 12th? This is the 12th. Yep. So it, oops. Oh God. Yeah. So that's actually a great analogy, Carl. So including this pre-market price action, like we went effectively from, call it 250 to, I don't know, what is this, 1050-ish, 11. This then holds up very, very well. And so notice, like we start to make kind of lower low, lower high, lower low, lower high, but then we break that, and there we get a higher high versus that. Then we make a higher low, pretty much similar, higher high, higher low, then boom, we break through that. So yes, this is very similar to VVOS. And this is something where like I would have this in my Evernote and include that. Then we can even analyze this one. Okay, this would be very good, but except for this kind of like fake out. And why do I think this isn't as good, like this specific bar here? Because we didn't consolidate far enough. We covered a lot of ground. I would have really wanted this consolidating all the way over, which we eventually did, and then we eventually go. And then, of course, the earlier the leg, the better. So those are a lot of games I've played on Twitter, asking the crowd, like, hey, what's a better setup? But that's something you all can do and collect over time, and you start to prove yourself right or wrong. So that's a good exercise. Good point, Carl. So then speaking of Carl asked a question on GNLN. So I guess we actually did end up kind of talking about this anyways. So then, let me see. So would I consider shorting GNLN a good idea after double tops on 8-14 using prior bar highs on the daily? 8-14. So blah, blah, blah. And so this is also the one that had the big offering, didn't it? So this is definitely something I would consider swing just because it's up so much. And if I recall, I mean, I don't have the details of that offering in front of me, but I think it was a pretty big offering. Am I right? Anyone, if can anyone confirm, was this the one that had the offering? Am I thinking of that right?
Yeah, it was
thank you.
6.5 million at 2.5 bucks.
And that was, I think, like here, so right, roughly?
No,
The offering was on day one.
yeah.
Oh, interesting.
Yep.
Oh, that's where it was. Yeah. Got it. Thank you. Yeah, all a little. Yeah, thanks for adding that to the chat. Got it. Yeah, then they completed. Got it. Um, so then the question was, would I consider using prior bar highs? The hard part though is like this is kind of rangy up to that one. So sometimes what's interesting is you'll get a pattern that kind of tightens a little bit. So like what would have been really cool is this bar here on 8-16, which I guess was Friday. If this was shifted up a couple points, like, you know how we talk about the some of the lower highs and everything, like this is a meaningful amount off of that. And I spoke about some of this stuff recently, like on the top op. So let me go to the Sirius. What was interesting with Siri on this week close day is that Siri ends up gapping up really high close to those highs. And so that makes it pretty interesting. So with this GNLN, it's not a bad idea to think prior bar highs might hold for now, but there's nowhere that I'd super love sinking my teeth in. And like, even if I short kind of this break where now we're below prior bar low, so maybe I'm shorting like $12, that's still almost $5 of risk. It probably pays off and it's probably decent expected value, but I don't love the ratios. Like I'm not super into it. So then another question was on CING on 8/16. I got short on the low of day at 11:38 a.m. Let me see this. 11:38. I got short on the LD. Oh, potentially. Oh, the limit down, not the low of day. My bad. But following the 2M. So one issue with this, so he's saying he got short here, but then got stopped out. One thing that's a little bit tough about this play is I don't love that short there just because we spent so much time consolidating at $11 and that's such a big breakout. So this is a little bit close for me to want to short there. So it's not that I mind shorting this low float, like I'll short generally anything. But it's just that this to me is a little bit too close to this breakout area. So I do think that was a good, like, it's definitely good that you took that loss on that break. But if I had to kind of pick on this trade, like I don't think it's an awful idea, but I don't I don't love it. Like it doesn't surprise me that didn't work just because like big picture, the trend is up on this, right? The daily is breaking out. This intraday is a really big breakout after we failed to go down. So like I would be fairly shocked if we fail to go down, we consolidate for hours, we break out, then we die that easy. So that is what would have stopped me from liking this trade. I probably don't think I would have taken it overall. Like it's not the worst idea, but I just, for those reasons, it's too close. If this broke out and we, say we went in a straight line to like 18, then we turned, then I'm much more interested. But it's just too close to the $11 breakout area. Like we just consolidated too long, too nicely, failed to break that I then think we're just going to magically collapse from here. So you said I've been trading a year and I feel like maybe I missed something important. So I think that's the most important thing you're missing is just simply it's just too close to this breakout, especially in like a low float that's really covering some ground like this. Just let me know in the chat if that covers it or if any other follow-ups. So let me see. Okay, I posted a video to one question on what I think are some of the best practices. Oh, you're welcome, Carl. Glad that helped. How would I grade the breakout on the CING? Overall, I think this is actually pretty good. So let me just quickly jump to the So in context, like, okay, this did, huge volume, super, super beaten down, piece of crap, if you will. Day one, so day two. And, keep in mind the volume this thing is doing is like ludicrous. Like this was doing no volume and now it's doing like infinity volume. So you need to be very careful. Like when stuff does volume this insanely highly skewed, like keep in mind that the average price, there's so much turnover that you get so much price turnover, or sorry, so much volume turnover that the average holder, it's like, every share known to man was just traded in these couple days in theory. So you can get some wacky moves when you have some of that dynamic. So as far as what I think, like the way I would interpret this chart is we were consolidating in a range. Like we then try to break down, we fail, we then reclaim. So now we've spent like a couple hours in this range. So how good is this? Oh, so we did break here, but like that's not a ton of consolidation or anything. It's not, I mean, I don't know, maybe I would have done small size there. But now what happens is when you fail to break down here, like a lot of longs get shaken out, a lot of people short, and probably against high of day. And so then once that breaks, it's so often you get more people stuck or more people off sides. And so I think this long was probably pretty good. I'd maybe give this like B plus. Like this kind of annoys me that this broke here. I don't think this was the tightest, cleanest thing. I do like how we make a sharp move up to 11. I really like this bar. This is a really, really tight bar against those intraday highs. So there's a lot I like. I mean, this is what I like the least. This isn't the tightest thing ever, but I really like that strong bar, tight inside bar, then boom, it's broken. So overall, I mean, pretty solid. I'd be much more eager to take this long than probably, that short or that short, for what that is worth. Why do I like that tight bar? There's actually many important reasons. That's an important question. So I'm going to actually take like a minor pause for you all to think about this. Like, why is this bar so important to me? What does this bar like do? And I'll give just a couple of seconds to think, because there's actually a lot of meaning in just that little bar. So first, yeah, little price acceptance. Yep. So we went from 10 to 11. Then we hold up tightly. So price acceptance. The Neil. Oh, there we go. Yep. So it's both those things. Like one, this bar is a signal of price acceptance that we're holding so close to those highs. Like that's really good. And why is no one shorting there? Why is no one selling there? We hold super tight. Then the other thing is a lot of times I'm risking off that prior bar low as my system. So the tighter this bar is, that makes that geometry even more skewed. So there's a lot of cool things that happen from that bar. And this even happens on daily charts. Man, I just pulled one up this morning when I was doing that video. Man, there was some daily chart where you had a really big breakout bar. You then had a tiny inside bar towards the top of it. Then it re-broke out. Was it an Apple? I don't think it was an. Let's see a couple ideas from the crowd. Let me see. Oh God, we're getting. First Solar. Oh, thank you, First Solar. Thank you, Monish. Yeah. So what's so cool, if you guys remember, I think I did a video on this, like you get this bar. So it's like, one, that's a massive move. We barely retrace, but then for a swing setup, I can buy this break and risk, just to there. And so imagine if this wick didn't exist. Like imagine if this bar was shifted up and the low of this bar was like 250. So let's say we had a bar that was like 250 by 252. In theory, I could buy, or let me see, what are these highs? Sorry, I have some stuff covered right now. I can't tell. 254. So let's say we had this daily bar was 250 by 254. Like I'd be able to buy that 254 break and just risk 4 points against prior bar lows to potentially catch this whole move. Like that's super, super asymmetric. So that sorry for the motorcycle. Were you guys able to hear that or no? Oh, that's amazing. Wow, that's so incredibly loud for me. This mic does wonders. So like that geometry is super, super important, right? Like that allows you to risk 4 points and catch a really big move. And then someone also said, yeah, ARM in March, like this one, or I guess in March, I don't know where in March, but anywho, so moral of the story is like, oh, in Feb, no worries, yeah. So moral of the story, what ticker were we on before? Sing, CING. So moral of the story is this bar actually is like super, super appealing to me for a couple reasons. Now, also keep in mind that like the most recent price data, oops, I accidentally typed that into it. So the most recent price data is also some of the most important. So that bar really showed some good strength into that resistance level. So good questions there. I think I covered all. So now there was a question from Luke. My voice is already starting to go on this ASTS. So I'm going to touch on this ASTS more on probably the August top op. So I'll keep this somewhat quick. This caught an upgrade this day, absolutely just explodes on it. What had otherwise been a pretty damn strong stock. And so one thing that's interesting is like, look how well this stock has held the moving average. So this is something where it's like, I don't know what's going to happen in the future, but this will like be on my back burner list of something I want to watch if it gets near the moving average. Like who knows how that unfolds in the future. But that's just something I'll watch because it's so far held it really, really well. And that would be like a nice potential break of trend. So this was like overall this move. And so actually I just used this chart in Magnum Opus recently for an example. Like this chart, nowhere was this chart a short anywhere except potentially more recently. Because look, we go up, we kind of consolidate, we have one up bar, then it's all just price consolidation. Then we go up just a little bit. Like the slope of this is like plus 0.2. Like it's a super low slope line. It's very, very gradual. We kind of go up, we have one up bar, then we just slide across. Like this is just sliding across. We're just riding the moving average. That is insanely, insanely sustainable. This can do this forever. And in no place would I ever want to short this. Even here, we get one big bar, we get another bar, but then we just consolidate across. We're consolidating, then that's where we get the super euphoric, insane, high volume bar. And so then what was interesting though is yesterday, or I guess Friday, this did set up. So this is where in general, and this was Robert's, I think Robert asked me this before. Robert's question, like, how do I weight these different things? In general, like, this daily chart, I want to be super careful of. Like, this is a huge breakout on massive volume. We did have a big upgrade. We did close very strong. So in general, like this bar went like over 10. I mean, this bar went a lot of points. We went from a low of 22 to a high of 34. So this went almost 12 points. So in general, I'd want to really let that next day go really, really big. That next day on Friday, we didn't go that far. So I don't love the daily for a short. But what was interesting is not the daily, but that the intraday set up so nicely because we went in such a clean line. Like, look how we go from 30 to 38 or 37 in a straight line, and we hold prior bar lows super, super well. So that allows for a very clean short entry. it's not that the daily I'm so in love with. The daily I'm like actually like somewhat bullish on. You know, the daily I want this to go way higher. What made this appealing, it just so happened that the intraday was really clean and good. That makes me think that when this does break, it might be also clean. So I don't think there's anything wrong with catching this short. I wouldn't expect it to melt all the way down there. In fact, that's what made me interested in buying this break of bar highs. Not that, I mean, this ended up kind of shitty setting up. But the thing is like, keep in mind, this stock was very steady, strong the prior day on a news catalyst. So like when that happens, where we've got news, we've got huge volume, it's steady, strong, I'm generally not going to expect this to just epic melt on itself. And we end up to kind of just like closing in the middle, and that doesn't surprise me. So I think the short is fine because of this intraday. I think the long is also totally fine. I don't think any of them are amazing, you know, because of the daily chart and everything else, but that's fine. So anything else I wouldn't have done in here. Let me check chat real quick. So Dong Lei asked, sorry if I mispronounced anything. The stock is up 800% in a couple of months. Do you think it's too extended? So yeah, this is what's so important and surprises a lot of people. I never view things on a percentage basis. Like the chart is everything. So just because this stock is up 800%, the way this was moving was incredibly sustainable. If this goes from $3 to $1,000, but it always maintains this slope. If we stair step and consolidate, in no way is that ever a short to me. No way. So I don't care about the percentage. I like, so many careers have probably been lost thinking about the percentage. I care about how it gets there. How it gets there is infinitely more important. And so it's very steady. The slope is very, look how we go from $8 to $13. It's just super gradual, and it's a lot of price acceptance. So how we do it is way important. Only here do we really start to explode. I mean, now we're extended, but I don't think we were before. So given that it took us the whole day to make a $12 move and it made a $6 move in 30 minutes on Friday, is that a factor that made the intraday appealing? Yes, it absolutely is. So what's being referenced is, again, keep in mind the daily chart. The point being made was, and so one thing that I'll add is like this chart, nowhere is this chart a short. Right? Like, yes, it's a really big move. We go from 21 to 33, but nowhere are we even above the upper Bollinger. Like nowhere does this really get extended anywhere. It's just very steady. Like that's just like a slope of one. Anytime we start to consolidate over, we pull back a little bit, we consolidate over. So like things can make enormous moves, and I will not short or touch a single share. Like don't forget, the example I give from ages ago, there was this Avago. It was somewhere in here. I think it was this day. If you go back to 522 or something, I know this is a weekly chart, but if you go back to whatever day this really shot up, fine. Hold on. Let me just fix the chart. Hold on a sec, guys. I'll find out for you. Things I do. Okay. Yeah, this day, 526. What year was this? 23. Let me just pull it up. I'll stop being lazy. 526.23. I think that's what I said. 526.23. You're right. Yep. So if I'm not mistaken, look how steady this was. And I tweeted this at the time. I tweeted this very early on, like, this is not a short. Like, does this not look, is this not the exact same chart as ASTS? Like, isn't that incredible? I don't actively trade anymore, right? I just don't. This is from May of 2023, almost a year and a half ago. And I was able to pull that out of the thin air, right? I was able to see that ASTS chart and say, oh my God, this is exactly the same as AVGO. AVGO was not a short. I tweeted that AVGO was not a short in real time. And that's how like experience makes me avoid so many losses that other people take. And that's how I have this mental database, right? And like now imagine when I was doing this 12 hours a day, that mental database is like everything is in there and it's like perfect recall because you're spending so much time, right? So this held the moving average the whole day, except, I mean, there, but it's still pretty much, but we never got extended. So keep this in your mind right now, and we're gonna go flip back to AV or oh god, I'm already losing it. ASTS. Okay. I need to go to. Okay. So look how similar that is. Is that not just mind-bogglingly crazy? Like, yeah, we had some minor breaks, but like these charts are very, very similar. In no way is this a short to me because we were never overextended over the Bollinger. Like it was a steady move, and we just consolidated over. And the AVGO, I think, is picture perfect. Like this did have some breaks and a little bit more extended at times. AVGO, picture perfect, steady, strong. Like that AVGO is the definition of this is a steady, strong stock. So to the original question's point, hey, you know, is part of what made the short appealing Friday on ASTS that it covered half this distance super quick? Yes. So it took the whole day to cover 12 points or so. So what was being implied was like, hey, like, you know, the next 6 we did super, super quick. Yeah, that's part of the appeal. Would I have liked it to go a symmetric amount in that time to really make the daily bar symmetric? Yeah, I would have loved that. But you don't always get what you want. But that's what made this you know, decently appealing, was the cleanliness of this trend, and then how quick it covered ground. Let me catch up on these questions. Oops, hold on a sec. Do I take short interest into account? I mean, kind of. But not really. I'd say like the chart overall trumps everything for me by far. But like I kind of want to be aware if there's short interest, just because things can get a little bit squeezy. And you do sometimes get maybe some more weird moves, but I don't overweight that. At the end of the day, I listen to the chart, and like short interest might be like the icing on the cake. I guess that's how I would phrase it, is like short interest maybe gets like a couple % weighting where applicable. Do I see any setup for the long and ASTS to capture the all-day trend / slow moving trend trades? You know, so essentially the question is, do I see any setup to kind of capture this? So some stuff does just trend all day, and I must admit, like I was never good at capturing moves like this. So for me, like, no, I don't personally tend to ever catch any of this. You know, I'm sure that like someone out there has some good system for this. But the truth is, no, I don't have a good way of capturing these. And that's okay, right? Like I can be a really good trader not capturing a lot of moves. Like I'm sure there's so many people with so many more different strategies that I've never imagined. And there's people that are just amazing at catching stuff like this and have really good vision for some of these trend moves. You can have a really good career, like just being very good at a couple things, right? Like unlike with poker, you can just pick a couple hands. So I can be good, really good at a couple things. And like, no, I don't need to know how to capture this. Not saying it's impossible. I'm just, you know, it's just nothing I'm good at. Yeah, I don't know. ORB is what I think works. What does ORB mean?
I think it's opening range break.
Opening range break. Got it. Yeah, I mean that might be fair, but like I guess my question then is what's the stop? And like, do you really never take off and you just hold the whole day? Like you can have systems, I'm sure, where it's like, okay, I'm going to give unless we break lows. But man, like Yeah, I don't know. I think if you then if you say I'm only giving it to back to lows or like the beginning range, I think you can probably end up losing a lot of P&L sometimes, like when these kind of retrace. So yeah, there's definitely going to be systems for it. But I don't think ever in my life have I ever caught because like this for me, there's not some if there was some really good setup, like if this consolidated for a couple hours, if this did like the CING consolidation then broke out, like then I've got something to work off of, and like let's say I even use some of these pre-market levels and I'm buying above this, it's like, dude, if I'm buying that, there's no chance I'm holding that the whole day. Like I would either be stopped out here or like a million other places. So I can pretty confidently say never in my life have I ever caught something like this. But yeah, I'm sure there's people that are better at it. But of course, it's a trade-off. Like keep in mind, if you're catching this whole move, I guarantee you your win rate on stuff like this is not super, super, super high. There's no way on earth you're capturing a move like this with like a 95% win rate or a 90% win rate. Just because that reward's so, so, so enormous. Inevitably to catch this, you need to have a looser stop, which is going to have its trade-offs. So there was one quick question on this NVIDIA as far as healthy pullbacks. Then I want to jump to some other questions. Yeah, I mean, incredibly enough, it's kind of amazing for what it's worth. Like it's markets are insane that like we can go from euphoric to oh my god it's the end of the world, then like a week later we're all the way back here. Like I did not think these would bounce so much, so I'm definitely keeping an eye on NVIDIA. I'm definitely keeping an eye on Avago, aka Broadcom. So like now if these start to like if these just jet to highs, there's no way I'm going to buy that or be interested in that because it hasn't consolidated enough. But like if you were to tell me Nvidia spends the next 3 months between 120 and 140, like yeah, that's super healthy again. And that's why like this stuff is so dynamic, right? Like people are like, oh, but back here, people are like, oh, is this a healthy pullback? It's like would you buy the break to highs? It's like, dude, I don't need to answer that question. I don't need to worry about buying the break to highs like when this might happen. Let it set up and let me face with that decision and know what the pattern looks like. Then I'll make that decision. So now it's kind of impressive. So maybe we consolidate and maybe by year end we make another move higher. I don't know. It could certainly happen. Let me see. So ASTS, so there is a question on catching the all-day trends. No, I have no good framework for that. That is just the truth. So one question from Mattia, if I'm getting that right. How to behave when there are both a daily setup and intraday setups on these same stocks? From his understanding of some of what I teach, daily setups must be structured on a daily time frame and intraday align with an intraday time frame and different size quantities, different systems, and so on. And so I would say that you're spot on. Like if something sets up on a daily and an intraday basis, I will definitely trade them both. And I'll trade them both kind of independently in my head. So maybe I have 10,000 shares long, and maybe in my head, 2,000 shares I'll do as a swing trade, and the 8,000 I'll do as an intraday trade with their respective stops. So I am trying to just trade them independently for sure. Are there any exceptions or cases where you have established rules regarding this, or is it experience that applies on a case by case? So in general, I'm trying to do exactly what you described. It's very hard to do just because, I don't know, for whatever reason, like psychologically, it's hard to like hold the core and divorce yourself from the intraday movements. But yes, I kind of hold a little bit of a core position. Then I'll also just kind of intraday scalp some things. I don't know if there's too many exceptions to the rule. I mean, here's the thing is let's say I'm long something like Apple and let's say Apple, I'm long intraday and as a swing, but it makes some really euphoric, amazing move. If it makes some capitulatory, amazing move, I'm going to sell it all. I'm going to sell the intraday and I'm going to sell the swing rather than give it prior bar lows, just because if something capitulates, I generally want to be out. So DC, my good friend asked, he wanted some color on M&A in the face of the Mars takeover of Kellogg's. Well, it's really Kellanova, but I'm going to call it Kellogg anyways. If you could elaborate on how I was trading these M&A breaking news trades. So what happened was, I believe, yeah, this was a Sunday, right? Yeah, so 8-5 is a Monday. Don't quote me on this. I don't have Google up right now, but I think Reuters came out and said, oh God, I think Reuters came out and said that Mars is in talks to potentially buy Kellogg. And so then Kellogg on 8-5, this just gapped up pretty much a ton. Let me see if I can find that. Is this 8-5? Yeah. So pretty much there were some pre-market prints and he's asking how would I trade some of this stuff? So the reality is like most of the bulk of this, like in an ideal world, this headline would have came out during market hours and I would have been buying this at 64, 65, 66, 67. That being said, all of these prints are probably very good buys given the headline and everything else. But because this headline happened over the weekend, there really wasn't much money to be made. This volume is pretty minimal. Then by the time we get to like 70 plus, I'm not sure I have some strong view on where this is going. So like most of my money would have been made buying the actual headline. Then what ends up happening, the actual headline, assuming it didn't happen over the weekend. Then what ends up happening is, again, the deal ends up getting announced overnight. And so this is a situation where like I probably would have made essentially nearly $0 on this. He was asking, are there any times where I'm building a position or, would I wait and do an M&A ARB anywhere? I would say in very rare situations, I would potentially hold a stock that I felt was going to get a deal. But the probably 95%, maybe 98% of my M&A headline money was when the headlines were coming out during market hours and being one of the fastest to piece together how far it will go. There were times where I had a very strong view on, oh my God, this is highly likely to get acquired at a really good premium. Like for example, maybe David Faber will come out on CNBC and say, advanced talks, deal could come this weekend. And for whatever reason, like I feel like the market's not pricing it in that well. Like there was it Virgin Airway? Yeah. So I think Virgin Air was bought by, oh God, who bought Virgin Air? I don't remember anywhere, but Virgin America was one ticker where the way that's set up, like, I think Faber on like a Friday said, oh, hearing the deal could come over the weekend. And like, for whatever reason, the market didn't respond that much to it. And I'm like, man, like this could, like, that's a pretty strong Faber headline. And I did overnight it over the weekend and it got bought out and I had like a massive chop on that. So there are times where I feel like sometimes it's just very asymmetric, particularly in like biotech world. There's been times where I've done stuff like that. But the short answer is a lot of the times I am just looking for these headlines during market hours. Thank you, JB, who said Alaska Air was a group that bought them. Yeah, that's what I thought. But thank you. I don't know if you guys are Googling this stuff or just off the top of your head or not, but we've got some good market knowledge saving my ass because I am old and forgetful. Let's see. So here's a question for the VIX daily swing. Do you put your stops pre-market to cover your short or wait for market open? So this is a good question. So if I'm doing something like the VIX, and this is going to be actually a weird because it's kind of arbitrary, but if I'm trading the VIX, the VIX, if I'm swinging the short on the daily chart, I am going to be using this daily stop of like, it needs to be market hours. So if for whatever reason, pre-market one day, we're above the prior day highs, I'm not taking that until generally market hours, unless something weird happens. Like if there's like a news event or if something's really, there's times I'll pull an audible, like especially if there's breaking news or especially if just something doesn't feel right or I think things could go really wrong, I might pull the trigger and get out pre-market. But in general, I want the trade to actually break on the chart, and I accept that gap risk generally. Again, any daily swing, I'm going to be way sized down versus an intraday trade. So for the most part, you kind of need to accept the gap risk. And like, you know, if on this day it closed here and we were going to open up at 83, I'm not closing that pre-market. I'm going to just, you know, end up just closing at the open and just take the gap risk. Which is now some might be asking, but like Lance, like the VIX has a different chart. Like futures, for example, are going to be like, you know, QQQ is going to be different than /NQ, and VXX is going to be different than, you know, /VX, the futures. And so you can end up with different charts. And like, that's totally true. So you might be like, Lance, like these products have different trading hours. Like that makes some of this stuff super arbitrary. And my answer would be, you're right. Like it is kind of arbitrary. Like there is a world where like VIX futures can stop you out and the VIX can still trend. So there is always some arbitrariness, and like, that's just part of the game. I'm sure there's been times I've been, you know, I just, whatever my rules are, I just follow the rules. And like, yeah, I don't know. There is some arbitrariness. Yeah. And so this person ended up holding the VIX. So, I mean, amazing hold and awesome job on some of that stuff. And you learned from the MU video. So amazing. Very happy to hear that. You are very welcome. Miguel asks, what do you do when playing capitulation where the previous bar? This is a great question. So Miguel is asking essentially, let's take something like this. Siri, was this a good one? So he's asking, what about when the previous bar was really rangy and we've pulled back a lot? And so what I'm going to say is I've already done a video and answered this before because it's such an important topic and I get asked this a lot. Towards the beginning of the Patreon, there's some video called like, you know, when to buy intra bar versus waiting for the turn. And I use like LYV. I use LYV as an example on
Bitcoin a couple times as well on the monthly top-ups videos.
Yeah. It was this day I did I did LYV 728 and answer that exact question. So refer back to that because I think I have like a 20-minute video because it's so important. But you're right, because when something is very rangy, you do need to factor in that the risk reward can be worse and impaired. There's a lot of times where a trade might be good, but it just doesn't set up well. And so that's where that geometry, like the stuff we were talking about on the CING intraday, those little bars, or like the first solar, like there's times where that geometry matters so much. You know, if this bar was super loose, I might need to give it just a tight stop above 254 or something, like, or I might just not take the trade at all. So there are times where that's super important. Okay, pretty much we've gone on a long amount of time at this point. So let me try to hammer out some of the last of these Patreon questions, just so we don't go on for infinity. Because I'm going to definitely lose my voice at this point. So we got Roberto's question on differentiating those questions. So then there was one on breaking news. Do you prefer a very explicit headline with a lot of details or just by knowing what type? So we kind of touched on that. And like, especially as you get more specialized, you can know when to parse those and not. So Derek asks, any advice for developing tape reading? And were there any aha moments for me? So my best advice on reading the tape is you absolutely need to do it on the stuff that's most in play. Like, do not read tape of the spiders. Oops. Do not read tape of the spiders. If you watch 1,000 hours of the SPY and its algos and its HFT bullshit, it's going to be a lot of time wasted. You need to not watch noise. Like the same way I showed you the chart of Ford and GM that was just doing nothing. Like you can't watch tape that has just noise. The same way, like if you were to watch a poker table and if on 90% of hands you fold, and there's nothing going on, it's not that valuable to watch tape of yourself folding again and again and again. What you really want to watch tape on is you in the best hands, you trading the best plays. And the level 2 tape is most important on the craziest stuff. So I might want to watch what did, even though it's more algoy than not, I might want to watch like what did the NASDAQ look like when we panicked pre-market? What did ASTS look like when this was turning? What did the Oracle news headline looks like when that came out? What did CING look like on this breakout? So I really want to watch the tape of the absolute most important plays. As far as what I'm looking for, like I'm really looking for the ratio of buying versus selling. Are there any large bids? It's not just what's happening, but how are people responding to different liquidity on the box? If there was a large offer at $11 in CING, are people scared of it? Are people chiseling the offer and coming down, or no? Or are we really pressing against that offer? Then boom, in one shot, the big offer gets taken and we explode. So a lot of that is what I'm looking for. I know someone recommended the SMB reading the tape program. I've not done some of their programs. I've heard decent things from people. Ymir enjoyed it. I can't speak to anything. I try not to speak to anything that I haven't done myself. But like ultimately it's like putting the time in on the really crazy moments, or even like that GME, like GME, any of those days where it was topping and going nuts is really good to watch. I'm going to try and do more content on the tape as part of Magnum Opus, but because it's such like, it's a really time intensive subject for me to tackle. Like I'm going to need to actually find examples. I'm going to need to go back to screen recordings. The thing that makes it super hard is like, I have a bunch of videos that I used for my career and I used for training people, but because it was done on firm software, I can't legally release any of that. Like they're just not going to let me release their software and everything. So that's been like my main constraint on doing this subject properly is I can't use all my recordings and like it's going to just take me a long while to reproduce that. But like long story short, I plan on making way better content. Like I've purposely avoided answering this for a while. But at some point for Magnum Opus, I'm going to get actually really good videos and really dissect some stuff. One thing that will help, like a couple weeks back, I did a video on GME reading the tape on my Twitter. Actually, it's probably on my YouTube as well. Like that's a good start. But overall, watching the in-play stuff and just watching it again and again. But I guess stay tuned for really good stuff is my short answer. But it's probably the most time-consuming content I could create, which is really been what's stopping me for a while. Question. So this going back to the VIX, and then I'm actually going to be done with the chat questions because I really got to finish what's left on the rest of these. Why might I still hold to prior bar highs versus taking off at the, moving average or something? I don't know. Like, so here's what I would say. This bar is pretty rangy and it goes back to geometry. So when we're this far back and when we started from 45, like we've retraced so much of this move. We're so far back. And so in a best case scenario, we might pull back another 10 points, which we did. But my risk at this point to these prior bar highs is also 10 points. So for me, like, as we approach here, this is when it's starting to become pretty wishy-washy and kind of like 50-50 to me, where like I don't think there's meaningful edge. So I was doing my covers into this, and I held such a minuscule sliver to here just because like that seems like a little bit asking for much. Like I'm not sure it's so justified to hold this far. And I think most of the time, like when this stop is 10 points away, you're probably pretty well off just covering. I mean, here's what I would say is like if you're still holding 100%, like let's say you shorted that pop into the close, if you're still holding 100% all the way to here, like I know that seems super impressive and it is, but I think it's probably the wrong decision in the aggregate because up here, the expected value is amazing. By the time we get to here, it's probably approaching, expected value of 0 or maybe negative. And like, yes, it pulled back 100%, but that's not really something I'm going to bet on, too often. Like I don't mind holding, like, I guess in percentage terms, let's put it this way. If I shorted 100% here, even by here, I'm probably down to like, man, you got to probably be down to 60-50% on this day. Cause like that range is so enormous all the way back up to there, like, especially when like you're dealing with risks, like was Iran going to do an attack and all this shit? Like, man, like that's a huge amount of risk to prior bar highs. That's 30 points. So, I mean, even down to here, I was covering a good chunk. There I was covering another chunk. And, then I probably had like 5%, couple percent, left for here. But now let me just hammer out some of the rest of these because I am getting very tired and losing my voice. When you were a younger trader, was there any best practices or mantras or mental models that helped you build that skill set as far as selectivity and discipline to only trade your edge? Like not really. Like I don't think anything. I was super undisciplined. I mean, I sucked in the beginning. Like I really, really genuinely sucked. Like I had no innate skill whatsoever. I did every mistake again and again and again and again. And my boss would just be like, dude, like, what's wrong with you? Like, how are you still making these mistakes? Like, stop making these mistakes. Every single day, he'd be like, Lance, why are you still fucking making these mistakes? 1 month later, like, Lance, like, dude, you need to improve. So I did these mistakes a million times. I don't know if anything helped me other than like you focus in on one issue each day. Like I think that's probably the best tip is like don't try and fix 10 things, right? I suck at golf and I'm trying to suck less. And with the teacher, it's like I'm a super good learner because he gives me and he's a good teacher because each lesson that I do, we're working on one small thing. Right. My golf swing looks like a dumpster fire. He's not saying, oh, Lance, what you need to do is these 15 to 20 things and you're going to have the, swing like Tiger Woods. It's not going to happen. Right. And so what he first did is Lance, like, okay, this is how you want to hold the club. That's what we started with. We did a whole lesson. Oh, Lance, like, nope, look where your hand is. You got to move your hand over. Look where it is. Then it was up, Lance, you're bending a little bit too much at the knees. And like, so we would work on these super small things each time. And then I would, perfect them and work on them over the course of the week. And now we're at the point where I hold the club the right way. I'm standing properly. My backswing is good. Then we're working on right now, me turning the body. And so my best advice is just work on one thing. And like inevitably though, what I find really interesting, like learning different skills is like, you can struggle at something. Like there's times where you go to the driving range and you're just like, oh my God, how am I this shitty? Like I cannot hit, like, this is so bad. I know I need to turn with my body. Like, why am I so bad at this? And you make the same mistake 30 times. And then you just go home and you're like, I suck. Like, I can't believe I'm so bad at this. But then you go to bed and you go back the next day and you're like, oh my God, like something happens overnight where your body processes this stuff and it builds those connections and you're able to be slightly better and you make those little millimeter corrections. And so what I would say is just like really focusing in on one specific thing, drilling, then going to the next one specific thing, and not saying like, oh, this is Tiger Woods' swing, I need to magically do that all at once, because you're going to do nothing at once. Hold on. I mean, there was a question about supplements. I answered that. I'm not gonna, that'll be a health video maybe in the future. When am I looking for further confirmation? What do I want to see for it to be game on versus having all my size at once? In general, I almost always try to just get my size at a specific spot. Whether it's prior bar lows, whether it's a certain intra-bar turn, wherever I think the really good expected value is, that's where I want it. I don't want to end up chasing or waiting for confirmation. I will then only play it if it becomes another setup independent of that. So in general, like, and so what's the best example? I mean, I'll give a quick one, right? What did I just do? What chart were we looking at? Where did why am I? So we were looking this day, right? Oh, here it is. I don't know why I got lost. So we have this nice little setup. We spoke about that little bar. What I talk about not waiting for confirmation is when this gets above $11, I want to be buying like 1105, 1102, 1110. A lot of people, what they'll do is they'll wait for confirmation, and rather than buying like 1105 or 1110, they're buying 1205 or 1210, and they're like, oh my God, look how good this setup was. Look how good it's working. That at that point is a chase. So that's the type of confirmation I don't want. I want to just buy trusting the setup being good rather than way, way higher. So really, I trust the setup, not the outcome. I don't want to wait and see that it worked to buy more. What strategies, if any, do you look at to take advantage of the tendency for volatility to mean revert? There are a few ways to play it, but I'll be interested to hear your thoughts. I mean, in general, like, I guess simply quickly touching on this stuff. One, how sharp was the capitulation? Like how, I mean, we went low vol to just explosive vol very, very quickly. There was so much stress in the system. Like the amount of contagion across the world was enormous. Anytime you're getting the Qs moving so much, you're getting Apple moving so much, like there is enormous stress and contagion in the system. This was a massive capitulation on the charts. So anytime that we get some really, really big spike, that's when I'm generally thinking like keep in mind in general, like VIX reversion is one of the best surefire trades there are. Like, not that it's surefire, because of course you can get blown up, but like, unless you assume the world is always going to infinitely tumble into like the end of the world, VIX does mean revert. Like crazy times do eventually lead to calm. Calm leads to crazy, crazy leads to calm. And so in general, mean reversion spikes, volatility does mean revert. Like once things go super crazy and the system breaks, inevitably things, get fixed, right? Like think about COVID. There was so many funds that were offsides or people that had to liquidate or this or that. But like that liquidation and that price correction is what leads to opportunity where you get different buyers coming in. So whether it's 2008, 2011, 2020 during COVID, this past month, as long as history has existed, volatility has mean reverted. I suspect one day, whether by meteor or plague or aliens or something, that might not happen, or like nuclear bomb. So then the question is like, how can I safely wait for the turn and position myself? And what are those signs that we've reached a high? And the one rule of thumb that was interesting to me is like so much of this, like I highlighted that Stephen Place video on my Twitter that I retweeted. Like so much of this panic was just like, it was really just, I don't know, contagion from the yen, which obviously seems a little ridiculous when people are selling Apple like 10% down. It's like, what? So those are all signs. Every time's gonna rhyme, but be a little bit different. And yeah, that's my quick answer because I gotta keep on running. So Ymir had asked about tools for news. I did a video on that. But in general, Bloomberg is, of course, the king. Second to that, as far as, well, actually, number one bang for your buck is Newswatch or NewsEdge or whatever. Bloomberg is 10 times as expensive, but probably 10 times as good. So toy around with those. There's a lot of, what I really love is in some of those comments, DC and Ymir talking about collabing a bit. I love that. Like, I think the other benefit of this Patreon is I really love seeing you guys form different trading pods, helping each other out, pointing each other to other resources and content. So thank you all for that. Definitely encourage you all to do that. Oh my God, and that was the last question too. Okay, that's amazing. So what quick things can I touch on? We've now gone 2.5 hours, which I think is the upper limit of most people's focus and probably most people's desire to even, at least other people can watch this on 2x speed. But yeah, what super quick things can I touch on given the extent we've already covered?
Okay.
What was that question?
I have two quick things to ask you, Lance. First one, pre-market trading. I started to doing it because I want more reps on breaking news, and I'm actually finding some consistency there. And then I captured the Starbucks headline last week, and I presented.
Nice.
Oh yeah, and I presented it to Jeff Holden, and he kind of congratulated me and warned me at the same time, because the liquidity risk during pre-market. So I want to ask you about it. What hidden risks could have that kind of obsession? Because breaking news is breaking news. It's about the session and the liquidity.
Yep. So, I mean, in general, anytime you deal with pre-market or after hours or especially overnight trading, it's always going to be riskier simply because there's less liquidity. There's going to be wider spreads. There's going to be less liquidity. So pretty much like, I mean, it's hard for me to think of an exception, but pretty much without exception, your risk will always be more elevated pre-market, after hours, and especially so overnight because of the lack of liquidity. So that is true. So great headline, great trade. Would have been better during market hours just because, if something's amiss or something's wrong, like think about it. If the spread is a couple pennies and you can get a lot of stock very quick, your reward is bigger and your risk is less. When the spread is like this and you need to buy up here and you can only sell down there, it's way scarier to do that. Yeah.
Second one, even faster. How important is ATR for your stock selection process?
ATR meaning average trading range. It's
Yes, sir.
important. Like, I would say it's important, but ultimately, like, I'm not doing anything quantitative with it. Like, I'm mostly just using my eye. I guess if I like on Stock Fetcher, I would have some filters that would look for big ranges or whatever. But a lot of times my eye is also processing like what's a normal day. Like if I quickly go to look at ASTS, overall volatility has been expanding. The ranges are expanding. Like this is a bigger day. I don't need to run any math. I can just see with my eye, this day's been bigger than most of these. What I can really see is this is the huge outlier. This is multiple average trading ranges. So I'm definitely factoring that as part of my analysis on the daily chart. And yeah, I'm using my eye, and it's definitely very important. That's what makes this day different than all these others, is it's so many multiples bigger than that. Yeah.
And not things like, okay, I am only going to trade stocks above 1 ETR or something like that.
In general, while I'm not super rule based like that, because so keep in mind, here's so and when you guys, okay, let's tie things from the beginning to the end, and that'll be my final thing for now. So Sean asked, what things are rules that we should dismiss? And I said, look, more important is just critically analyzing different things. So your thought was, should I only be trading stocks that are doing more than one average trading range? And so I always like to ask myself, where might there be exceptions to the rule, or where might that hold true? What are the pros and cons of that? So right off the bat, I can think of one exception: breaking news. A lot of breaking news headlines, they haven't moved yet. Starbucks was a great trade for you. The stock hadn't moved. It hadn't gone one average trading range. So maybe you then start to create a rule. If it's breaking news, I don't need it to be doing anything. It's irrelevant, right? I just figured that out in my head, right? Logically. But if I'm doing mean reversion, that might be very relevant. Is it relevant in breakouts? Probably not. Like maybe it hasn't done a really big move yet. Like if I look at Apple, Apple was kind of moving, but it didn't need to have such a big range when it broke 200. If this set up super tight, I'm still buying it, even if it hadn't moved yet. In fact, most breakouts, I want to move before it's made the huge move. I want to play and enter before the huge move. So for stuff like breakouts, where I want to catch the expansion of volatility, that's not a good rule. But I would argue for mean reversion, it might be. Can I find examples where it breaks the mean reversion? Maybe potentially. Like what if in stuff like trying to think here's a good example. Like in Tesla. Tesla had this really big up move, but then this bar started to get small. So nevertheless, like if we break trend, even with this small bar, I might still want to do that for mean reversion. So like that's where I don't have the right answers, but you want to critically think about some of this stuff. And I'm going to cut that off there. The two final questions, then I'm 100% full stopping. Favorite aftermarket hour times for catching setup/trading. I would generally say I don't have any. Like if I'm doing anything after hours, it's got to be super, super in play. Just because I don't want to just stick around forever. Then otherwise the big headlines can happen just at any point. So I wouldn't say there's any magical time for after hours or pre-market. What I would say is pre-market, news does tend to come out 9 a.m., 8:30 a.m., 8 a.m. You're less likely to get a headline at 4 a.m. and 5 a.m. than 8 and 9 a.m. You're more likely to get a headline at 4:30 and 5 p.m. than 11:27 p.m. So I would say those are some exceptions as well. Then the final question was, can we beta test MO? I'll probably end up like pre-releasing some stuff for you guys to testing. Here's the hard part though, is like when you request feedback, especially for something artistic, you can get 5, like if I ask about the logo, which I tried to avoid, you can get 5 separate opinions from 5 separate people. And the other thing is, by the time I'm ready to release Magnum Opus, like I'll definitely want beta testers as far as functionality on the website. But ultimately, if someone's like, hey, you're missing these 7 topics, or like this example you messed up on, or like this wasn't clear, or like, once I've recorded these videos, like my ability to change some of that is going to take a long while. So it will be more so like website function than anything. And if then, because ultimately if people are like, hey, this course actually isn't that good, well, it's going to be like, well, I can't do anything about that now anyways. So I'd rather not hear that after devoting 10 months of my life. Actually, by the time it releases, it'll end up being like 13 heavy months. Well, anywho, any final things? Appreciate the support, more people than ever. This was the longest AMA by a mile, so appreciate all the questions. My voice is tired. and I'm hungry. So this was awesome, guys. Thank you all. I will post the recording. It's going to take me forever to upload. Thank you for your attendance. And yeah, everyone have a good one. Good luck
Thank
trading.
you,
out there.
Lance.
Thanks so much, Lance.
Yeah, thanks, Lance. Appreciate it.
My pleasure, guys.